Hello, dear friend. Welcome back. Today, we are answering the one question that stands between most people and their financial freedom. What on earth is a fund, and which one should I pick? Stick around and I will explain to you in simple and practical way, and give top performing funds this year and show you how to go about them. Now, let me explain the meaning of funds, the investing funds. Think of investing like grocery shopping. If you want to make a complex stew, you can buy every single carrot, onion, and potato individually. That's like buying individual stocks. It takes time, and if one potato is rotten, your whole stew might taste a bit off. A fund is like a pre-packaged stew kit. Professional chefs, or math-heavy algorithms, have already picked the best ingredients, chopped them up, and put them in one container for you. When you buy a share of a fund, you own a tiny piece of everything inside that container. Today, we're breaking down the big four: index funds, MMFs, ETFs, and hedge funds. We're going to look at the why, compounding, the how, management, and the ouch, fees and risks involved while investing in these funds. By the end of the next few minutes, you'll have a PhD level understanding of how to put your money to work. Let's get into it. Let's first look at the engine, compounding and the math of wealth. Before we pick a fund, we need to understand the fuel in the engine that makes the wealthy grow, compounding. Einstein supposedly called compounding the eighth wonder of the world. Why? Because it's the only way regular people can turn small amounts of money into fortunes. Practical example. Imagine you're 25 years old and you put $500 a month into a fund that grows at 8% a year. By age 35, you've put in $60,000, but your account is worth almost $90,000. By age 65, you've put in $240,000, but your account is worth $1.6 million. The magic happens because your interest earns interest. Look at that t in the equation. It's an exponent. That means time is the most powerful part of the formula. The type of fund you choose determines your R, rate, and your fees, which act like a leak in your bucket. If you pay a 2% fee, you aren't just losing 2% today, you're losing 30 years of compounded growth on that 2%. Let's now go to the funds. 1. Index funds, the set it and forget it hero. Let's start with the king of the retail investor, index funds. What is it? An index is just a list. The S&P 500 is a list of the 500 biggest companies in America. An index fund is a pot of money that buys exactly what is on that list. How it works. This is passive management. There is no genius manager picking stocks. If a company joins the S&P 500, the fund buys it. If a company fails and leaves the index, the fund sells it. The pros are: 1. Diversification. You own Apple, Amazon, and Microsoft, but also the boring companies that make toilet paper and electricity. 2. Low fees. Because there's no expensive manager to pay, the expense ratio is tiny, often 0.03% to 0.1%. The risks. 1. Market risk. If the whole stock market goes down 20%, your index fund goes down 20%. There's no safety net other than the fact that the market historically goes back up over time. The second one is MMFs, money market funds, the financial safe harbor. And sometimes you don't want your money to grow aggressively. You just want it to be safe and accessible. That's where MMFs come in. What is MMFs? An MMF is like a high-interest savings account on steroids. It doesn't buy stocks, it buys cash equivalents. How it works. The fund buys short-term debt from the government, treasury bills, or massive, stable companies. These debts are paid back in 30, 60, or 90 days. Because the timeline is so short, the value of the fund almost never fluctuates. Practical example. You have $10,000 you need for a wedding next year. You don't put it in an index fund because if the market crashes next week, your wedding is canceled. You put it in an MMF. You'll earn a steady interest rate, often 4.5% depending on the economy, and your principal stays safe. The risks or the cons are: 1. Inflation risk. MMFs rarely beat inflation by a lot. Your $10,000 stays $10,000, but in 10 years, that $10,000 buys fewer groceries. 2. Liquidity. While very liquid, they aren't instant like a debit card. It might take a day to get your cash out. The third one is ETFs, exchange-traded funds, the modern evolution. This is arguably the most popular way to invest today. What are ETFs? An ETF is essentially an index fund that got a makeover. The exchange-traded part is key. How it works. A traditional index mutual fund only updates its price once a day at 4 p.m., but an ETF trades like a stock. You can buy it at 10:11 a.m., sell it at 10:05 p.m., and see the price move in real time on your phone. Practical example. Say you want to invest in clean energy. You don't want to pick one solar company that might go bankrupt. You buy a clean energy ETF, like ICLN. It holds 50 different solar, wind, and hydro companies. Fees and management. While most ETFs are passive, low fees. Some are active ETFs, where a manager, like Kathy Wood at RK, tries to pick winners. These have higher fees, 2.75%. The risks. Volatility. Because they are so easy to trade, people tend to panic sell them more often than traditional funds. First, tracking error. Sometimes the ETF doesn't perfectly match the index it's supposed to follow. Hedge funds, the VIP casino. Now we get to the one everyone hears about in movies, hedge funds. What does it entail? A hedge fund is an aggressive fund for the ultra-wealthy. To get in, you usually need to be an accredited investor, making 200K plus a year or having $1 million in net worth. How it works. Unlike index funds that just buy and hold, hedge funds hedge. Not shorting. They bet that certain stocks will fail. Leverage. They borrow massive amounts of money to multiply their bets. Complex assets. They buy private companies, distressed debt, and weird derivatives. The management. This is hyperactive management. You're paying for a team of mathematicians and ex-spies to find a secret advantage in the market. The 2 and 20 fee structure. This is the most expensive way to invest. TIDIC, 2% management fee. You pay this every year, even if they lose your money. A 20% performance fee. If they make a profit, they take 20% of the gain. The risks. Transparency. They don't have to tell you what they're doing. Time. Lockup periods. You might not be allowed to take your money out for 1 to 5 years. Blow-ups. Because they use debt, leverage. If they are wrong, they can lose everything overnight. Final practical tip. Most of you watching should spend 90% of your time looking at index funds and ETFs. They are the most honest tools in the shed. They keep your fees low and let compounding do the work for you. Remember, investing isn't about being the smartest person in the room, it's about being the most disciplined. Pick a fund, set an automatic contribution, and don't touch it for 20 years. If this deep dive helped you clear the fog around investing, do me a favor and hit that subscribe button and the notification bell. If we get 5,000 likes on this video, I'll do a follow-up showing you exactly how to open an account and buy your first ETF step-by-step. Let's now dive into the top 10 hot funds dominating this year. Now that you know how these funds work, you're probably asking, which ones are actually good right now? It's February 2026, and the market landscape has shifted. Here is a curated power list of 10 funds that are dominating their categories this year based on low fees and performance. The core 3. 1. Vanguard S&P 500 ETF, VOO. Still the king. With a tiny 0.03% expense ratio, it's the most efficient way to own the 500 biggest US companies. 2. Fidelity. Zero Large Cap Index, FNILX. This is a disruptor fund. The fee is literally 0.00%. If you want a free ride on the US market, this is it. 3. Vanguard Total Stock Market ETF, VTI. While VOO only has the big guys, VTI gives you all 3,500 plus US companies. It's the ultimate own the whole country button. Let's move to growth and modern trends. At number 4 we have Vanguard Growth ETF, VUG. For those with a higher risk tolerance, it focuses on tech and innovation. In 2025, it outpaced the broader market by nearly 5%, and that momentum is carrying into 2026. 5. Vanguard Russell 2000 ETF, VTWO. Small cap companies are making a huge comeback this year as interest rates stabilize. This fund lets you bet on the underdogs of the economy. At international exposure, at number 6, we have Vanguard Total World Stock ETF, VT. If you don't want to bet just on America, VT owns companies in every developed and emerging country on Earth for a tiny 0.07% fee. 7. iShares Core MSCI Emerging Markets ETF, IEMG. 2026 is a massive year for India and South Korea. This ETF is the cheapest way to get a slice of those high-growth markets. For safety and cash, the safe harbors, we have 8. Vanguard Treasury Money Market Fund, VUSXX, currently yielding around 3.6%. It's basically as safe as cash because it's backed by US Treasuries. 9. Vanguard Federal Money Market Fund, VMFXX. Another heavy hitter for your emergency fund, keeping your principal rock solid at $1 STRO. The passive income pick. 10. Schwab US Dividend Equity ETF, SCHD, for the income investors. It only buys companies with a history of increasing their payouts. It's the gold standard for watching cash hit your account every quarter. The hidden killers, fees and inflation. Before we summarize, we have to talk about why your choice of fund matters so much for your final exit number. I mentioned earlier that a 1% fee can eat 30% of your gains. Let's look at a hedge fund versus an index fund. If both funds grow at 8% for 30 years, but the index fund, 0.05% fee, turns $100K into $991,000. The hedge fund 2% fee turns that same $100K into only $574,000. You lost nearly $400,000 just in fees. That is the cost of active management that fails to beat the market. This is why simplicity usually wins. Final practical tip. Most of you watching should spend 90% of your time looking at index funds and ETFs. Pick one core fund, like VOO or VTI. Set an automatic contribution and let time work its magic. If you found this helpful, hit that subscribe button. I put the full top 10 list with their ticker symbols in the description below. Would you like me to do a video next on exactly how to read a prospectus so you never get tricked by hidden fees? Let me know in the comments. Stay disciplined, and I'll see you in the next one.